No. Can you ladies hear me? Can you see me?
Yes, we can. Can you hear and see us?
Wonderful. I can hear and see you clearly, and I see the photos in the back are up. That's awesome.
Perfect. Yeah, we put up artwork for this one. No.
Love it. Happy Tuesday to both of you. We've got a pretty big conversation today, but I wanted to give you folks just a chance to let the individuals that are on our live right now and the ones that will be watching the replay a little bit about what Zavitz does.
Awesome. Well, yeah, so we're Zavitz Insurance and Wealth. I'm Justine, and this is Samantha. And our company has been around for about 39 years, started by my mom. We are very well known in the industry for our knowledge and expertise and specialization in insurance and insurance planning, especially for self-employed professionals. But over time, we've really expanded our focus and our reach with our clients to include that kind of overall wealth management. And wealth management to us doesn't necessarily mean managing their money, but it means helping pull together all the pieces of their overall wealth, their taxes, their savings, their corporations or businesses, their incomes, their properties, and so on, and putting it all together to make sure that what they're accumulating and where they're heading in life is, or what they're doing from a financial perspective, is going to help them move forward with where they're going in life. So it's really bringing all those pieces together to paint that holistic picture for them. From there, we then obviously implement any of the insurance or risk management side of it, and work with other professionals to get the rest of the plan going. That's
just on the surface, right? There's so much more. And what I like about you folks, and especially if any of you have tuned into the website already, you folks think about the risks that others might not have the time to think about, or not even calculated the fact that those could be risk factors, which is amazing. And that's why it's so important to have the right people, financial advisors, involved in your decisions, especially if you are self-employed, which is a big topic now these days, especially after COVID. Yes, so we're going to dive right into it. So I know that we're, with tax season coming up, there's a lot of things to think about, but let's touch a bit upon those that are self-employed, because that seems to be the case for, whether they are self-employed or have their own business on the side. This seems to be the case for over 2 million Canadians. A little Globe and Mail article that was posted just at the end of last year, 2021, it reported that over 2 million Canadians either started their own business, like started off from their career path and started their own business, or created a side business on top of their full-time job. So that's a huge number. Now, my question to you ladies is, many people when they start their businesses, they start to think about getting incorporated. When is a good time for businesses to get incorporated?
It's a great question. It's one we hear all the time. And we hear it either, before people even really start their businesses, in the early stages of business, kind of across the board. A big thing to know is it's not something to do lightly. And the right time to incorporate is going to differ for everybody. So once you do it, it's going to impact your business in a lot of ways. We want to make sure that we're doing it at the right time. There are certain circumstances where you're going to need to jump into incorporation a little bit earlier than maybe the average person would. If you really need that creditor protection, or if your business needs access to credit or to financing in some way, it's typically easier to access that as an incorporated individual. Outside of that, I always say to my clients, you want to make sure that you're fairly stable in where you're at with your business. If you have a maternity leave, planned time off coming, if your income's going to fluctuate a lot in the coming years for whatever reason, or your need for income is going to fluctuate, that might be a sign that you should hold off on incorporating until things are a little bit more concrete. But a good rule of thumb is when you don't need all of your income. Incorporation is primarily a tax deferral strategy for most people. So if you are going to take 100% of the income you earn out of your corporation, don't pay that accountant extra money to file that return and set you up as an incorporated individual. It's not going to work out for you. And so once you don't need all of your income anymore, if you're not aggressively paying down debt, if you're already kind of utilizing your tax-free savings account and your RSP, and you feel like, I'm not getting as much out of the deductions I can make on the personal side, that might be a sign that you're ready to incorporate. Keeping in mind that there are a lot of considerations kind of around your personal planning that you'll still want to take into account, which Justine's going to talk about a little bit more, I think.
Yeah, for sure. I mean, like on top of everything Sam said, really to her point is that like when you incorporate, you now have like your personal return and your corporate return to file. And the corporate returns are always a little bit more involved, so they tend to cost a lot more money. So you have to factor in, there has to be enough tax savings for you on the deferral side by leaving money in your corporation and not needing all of your income, and therefore putting your personal self in a lower tax bracket, to offset the added expenditure of the corporate fees and costs associated with your accounting and legal fees go up quite a lot. So
especially in that first year.
yeah, so that's a huge one when everything else, when you're not worried about the limited liability, the creditor protection and the creditor access to credit and so on. That's really the big hurdle that we look at. Have you used up all of your personal tax planning capabilities like RRSPs and such as well? Because if you've got like all of your student tax credits still and RRSP contribution room, like why pay the extra money when you have tax planning capabilities on this side of things?
Very true. Very true. And all those kinds of like, we're talking about, and Sam, you actually mentioned it, sometimes in corporations are that way to kind of leave out some tax items, and we'll kind of actually talk about that in our third question. But a really important question that a lot of businesses or individuals have when they get incorporated or start their own business, et cetera, is whether they should pay themselves in salary or in dividends. Now, we know that dividends tend to have a lower tax kind of bracket kind of thing, not tax bracket, but a lower, it's on the lesser side than paying yourself a salary, right? So we want to kind of ask you folks, what would you recommend? Is it salary, dividends? What's the difference between the two? It can be a little bit gray for some folks. Why would one go with the salary versus dividend, or dividend versus salary, et cetera? If you can just kind of shed some light on that, that would be great.
Yeah, it's one of our favorite questions, right, Sam?
Oh yeah, for sure.
Yeah, and we get it a lot. And I mean, obviously in the world of financial planning, the answer we give to most people is, well, it just depends, okay? It depends on you and what we need you to do. So salary is you paying yourself as an employee from your corporation, okay? It attracts CPP deductions and contributions from both the employee and the employer, and but it's a business expense to the corporation. So if your corporation earned $500,000, you paid yourself $100,000, your corporation is only paying tax on $400,000 of corporate income. You personally then pay the tax on $100,000 at the personal tax brackets. Dividends, on the flip side, come from the after-tax profits of the corporation. So in that same example, if you earned $500,000 but you didn't pay any salary, your corporation gets taxed on $500,000. It's left with whatever that math is, 400 and something, and then you can pay yourself a dividend out of that. Because dividends have already been taxed inside the corporation, that is why they have a lower tax rate personally. So for the business owner, in the world of the Income Tax Act, there is this theory of integration. And the theory of integration is meant to make it equal for the business owner, whether they take salary or dividends. So the top marginal tax bracket as a person is 53.5% in Ontario, I should mention.
Yeah.
The top marginal, yeah. So for the rest of you, I think there's only a couple, like maybe one Atlantic province that is worse than us. So the rest of you can feel a little bit better about your personal tax brackets. The top marginal tax bracket on one type of dividend in Ontario is 47.74%. But if you factor in that the corporation already paid tax at 12.2%, you add that to the 47, did you really save any taxes? So it's one of those things that it's a bit of a misnomer where people think that you're saving tax on dividends because it sounds like it's a lower tax bracket, but you forget about the fact you've already paid tax in the corp. So salary versus dividends, when you factor that out, it's not an ever perfect math that the government has figured out for you, but it does work out to be approximately equal. So then we have to factor in some of the softer things. So for example, CPP, I mentioned, when you pay salary and you are the employer, you have the pleasure of paying both the employee CPP contribution and the employer CPP contribution. So it kind of doubles up your CPP costs, which can be looked at as an added tax. Some people like CPP. Some people think, great, I get a pension at the end of the day out of it. Like, that's wonderful. Other people are like, I don't know, is CPP really going to pay off for me? I'm like 30 years old. I'm not going to retire for 35 years. Is that CPP even going to be there? Is it going to be valuable? What is it going to look like? So they don't necessarily care so much about CPP. Salary, though, is also the driver of RSP contribution room for you. So if you don't pay yourself a salary, you will not be able, or you will not be accumulating RSP contribution room. So if you subsequently want to make an RSP contribution, you don't have any room to do so. And again, some people love RSPs and some people hate them. What our personal beliefs are, our corporate beliefs, if you will, our culture here suggests that we love seeing people with multiple buckets of savings so that at time of retirement, we have some flexibility based on whatever the tax rules are that day, because retirement can be 35, 40 years out. We don't know what it's going to look like. But on the day that you retire, we've got multiple options to figure out how we're going to make that retirement income most tax efficient based on today's tax rules. If everything exists inside your corporation, all of your savings are in there, and all of a sudden dividends, that theory of integration, some government came along and threw it out the window, and now dividends are taxed at 62%. Well, that kind of sucks, right? Now your hands are tied, you have no flexibility. So having some RSP can be nice, and so salaries is what drive RSPs. The other thing too is with corporations, there are some opportunities for having an individual pension plan or a personal pension plan. There's all sorts of different names for it. There's effectively the same thing, small little differences. But these, you know, at a certain age, it can make a lot of sense to set up an IPP or a PPP. And these IPPs and PPPs are most valuable for people who have a history of salary and RSP contributions. So if you haven't been doing that in the past, it can affect some of your future planning. So, and then there are even, again, more things that I'm going to mention, things like, let's say you set up an employee benefits plan for all of your employees in your office. Are you considered an employee if you don't pay yourself a salary? Like, do you even qualify for these wonderful health benefits that you're providing to the rest of your employees? Right? It's a great question. And some accountants argue yes, and some accountants argue no. So you could, again, be tying your hands that way. So there can be a lot of value in that salary. There can be a lot of value in the dividends. And a lot of the time it changes. It's like, let's do a bit of a blend right now. And then maybe in 7 years from now, we're like, let's start clawing back a little bit on that salary and ramp up the dividends a little bit more, because it doesn't make as much sense to be making use of X, Y, and Z.
Yeah, I think actually you started off pretty well, because there's so much that can actually consider here, and it really does depend. And I think when we kind of break it down, it depends on what that individual values more, probably, in terms of, okay, do I really see, like, again, to your point, like my pension, like, is that something I really want to contribute to? Do I see that? At the end of the day, folks need to kind of understand the thing that a financial advisor knows the ins and outs, understands this, versus, you know, some people are like, I'll Google it, I'll figure out, but there's so much, as you just kind of noted. And in a sub question to this here is how, and I think you've already kind of touched upon it, is how can a financial advisor shed some light on all these kinds of tips and tricks, the ins and outs of being able to kind of decide whether you're going to go with a salary, whether you're going to go with a dividend, where you can save on taxes, where you can kind of benefit for yourself right now, and make sure you're covered for the long run as well. So I don't know if Sam or Justine, you want to kind of just give us some tips and tricks on how a financial advisor can really make that difference.
Sure, I'll jump in, and then Sam, I'm sure you have more points, so you can add it on top of mine. But usually where I like to start is when someone's newly incorporated, is figuring out what do you actually need to live off of on an after-tax basis. Then we have the conversation around, you know, value in RSPs, value in CPP. What is the long-term game plan for your corporation? If you are saving all your money in your corporation, but you're going to subsequently sell your corporation, it can have a lot of impact on your capital gains exemption. So there's then further planning on things like holding companies, and it can get very complex. And if that person doesn't want that complexity in life, then that can help us with that conversation a little bit more. And so once we have those conversations and understand even education savings and how we're going to fund the education saving for children, and how quickly or not quickly you're going to need this money, is it to buy a home, or is it to, you know, fund your mat leave or whatever, then you can start to do some backwards math around, okay, here's what it looks like if you take salary. And for, you know, financial advisors, this is like our favorite part. Like, let's get an Excel spreadsheet going and do some math to look at what is going to be the short and the long-term impact of taking that salary dividend mix, or salary only and contributing to RSPs, or dividend only and stashing everything in the corporation. When are we going to run into things like passive income in the corporation because you've left all your money in there? Are we going to run into something like you've earned so much money in the corporation, you should take salary so that you can still qualify for the small business deduction limit in your corporation taxes and so on? Like, there's all sorts of things we start playing around with. And then we say, okay, this is definitely for the next couple of years, this is perfect. And then let's reevaluate in a couple of years, because new governments come in, they do new budgets every year, it changes all sorts of things that we then want to reevaluate.
Yeah, I think I definitely echo all of those things. The only thing I would add is, I think we live in the Google generation, and a problem with living in the Google generation is Google's not going to address the softer side of finance. They're not going to integrate things. They're not going to make sure that everybody on your financial team is, working together and coordinating and keeping everyone on the same page. And I think a financial advisor can really help to do those things as well. Google's just never going to give you that softer side of finance that talks about like the warm and fuzzy, not just, here's things you can deduct from your income.
Mm-hmm. And you have to remember too that you can pay your family as well if they are actually working for you, right? So I've got people who pay their children because they shred documents for them. Like, my kids could shred my documents, right? I could probably pay my kids some money. So when you factor in things like that too, it's really getting creative with your personal circumstances without pushing the limit on the tax man who might come audit you.
Yes, and this is all such good stuff, because again, going back to that Google era, like millennials are like, I'll just Google it, or there's the tool online, well, I'll just punch the numbers. Well, the thing is about all that is, yeah, sure, go ahead and punch the numbers, but that little tool is not going to tell you about, again, the softer side of things, or where you can actually save some money. It's just going to populate what you punched in, not the ways that you can actually, hey, did you consider doing this? Hey, did you take, and that's where the role of the financial advisor comes in for sure. So these are all such great tips and tricks, especially since so many individuals, either have their own, business on the side, or their own, they're, for someone who's worked their entire life and then decided to go on the business route, maybe they did contribute to a pension plan their entire life or something, savings, and now things have changed for them. And again, there's a lot of unpredictability when it comes to the government, of course, because there's different things that come up and you never really can plan for that. But that's what helps to kind of, hey, by the way, this new law kind of kicked in and this is what we can do about it. And then, kind of encapsulating everything and bringing it back to our getting a jump start on tax season topic is, how can individuals reduce their taxable income? And I'm going to read a few questions, because we had actually asked someone that owns their own business and works full time to kind of ask us a question that we could post on the call today. And that is, how can they reduce their taxable income by writing off their taxes? And what would you, as financial advisors, recommend they write their taxes off on? Yeah. So this was a question from someone.
Yeah, it's a good question. It's a common question. And I think the big thing to know is you have to be aware of what you can deduct against your taxable income and what you can't. And there is a little bit of a gray line on certain things. You have to be a great record keeper. You need to have documentation to support everything. For example, if you're just running off a credit card bill, the CRA doesn't accept a credit card bill. They need actual receipts of what you're doing. So there are certain things that they're more stringent on, like vehicle mileage. You have to make sure that you're really hitting it out of the park in terms of keeping a log of your mileage, where you went, why you were going there, et cetera, and staying within the bounds on that. Generally, I think what we're able to deduct is fairly common knowledge. Legal fees, accounting fees, license fees, expenses directly related to your business, like a home office, writing off a portion of your home because it is serving as your office is a big one, advertising, postage. Having records of all of those things is really important. But I think above that, knowing what you're not able to deduct is typically a bigger part of things. So, you shouldn't be deducting your disability insurance. If you have a golf course membership, yeah, that's networking. But it's really not. It's not deductible. There's some advertising that's restricted. There's some legal advice that even, if you're buying a capital property, any expenses associated with buying that capital property aren't deductible. So working with an accountant and having them on your financial team, and even a good bookkeeper, is really important, because you can get yourself in a lot of hot water. more so, be careful how much you write off too, because that can limit your access to both insurance and sometimes credit as well. If you're really whittling your income down to nothing, that's going to be a problem for you. Specifically, when talking about somebody who has an employment, like a standard employment job, and they have a business on the side, something that I was mentioning to Justine the other day is often I find people are caught where their employer is deducting tax from their paycheck based on their income, but they don't know you have a side business. So they're not increasing what they're deducting to account for that income. And maybe you're saving to pay the tax bill for your side business, but you're probably not saving enough because your total income is going up and your employer doesn't know about that. So they haven't been taxing you high enough. So at the end of the day, you may end up owing more in taxes than you were expecting because your total income wasn't being accounted for. So just little things like that that your financial advisor is probably going to bring forward to you that maybe you don't think of on your own.
And, you know, one of the best things an accountant ever said to me was that there's like tax deductions, deferrals, and division, but there's hardly ever tax avoidance. So deductions are always giving you, I know, except for like any life insurance geeks on here, life insurance. But anyway, they're like deductions are by far the greatest because they're going to reduce your taxable income. But as Sam mentioned, you can only deduct what you can deduct. And they have a pretty finite list of that, and they're pretty diligent at checking that because people, you know, I know someone who was like, wow, part of my job is like seeing how these skis might help your knees or something. So I wrote off all my skis and I was like, oh, whoa, I'm so glad I'm not your accountant.
I think that every day.
I'm back to
I'm not your
And
accountant.
so, yeah. And then, so, you know, it really, you want to be careful on what you deduct. At the same time, you want to make the most of everything you can deduct. So just be like super familiar with it. And then deferral is things like putting it in your RSP or putting it in a corporation where, you know, you're deferring that tax to a future date when you're going to start drawing that income, and hopefully you're in a lower tax bracket. And then dividing is paying amongst your family. But again, the tax is going to be there one day. So always plan for the tax.
Yes. Tax at the end of the day is there. And I know that there's always that saying, though, you know, pay yourself first and add tax kind of thing. What are your thoughts on that aspect?
Yeah, I think that that's a great recommendation. Pay yourself first. Another thing that I often find with my clients is they're not sure how to save for taxes and where they should save for taxes and all of that. And sometimes that kind of gets lost in the mess of thinking about everything else.
Mm-hmm. Yeah, we always tell, especially like very new to self-employment, is like just rule of thumb, depending on how much income they think they're going to make, like put X percentage aside for taxes. And whether that aside is like a high interest savings account or like just a separate bank account that you can't see or whatever, so that you know that like is a no touch account for you. You don't touch that one, it's there for the tax man later. And then everything else, then you say, okay, now I'm going to make this RSP contribution. That's the pay yourself first piece of put those savings aside. And then you can spend whatever you want to spend.
Yeah. Awesome. I honestly, because you know, that tends to come up a bit, but then there are two minds of that. You know, it's like, well, I can't pay myself first if I don't know how much I have to kind of put aside, how much I have to owe. And I guess that's what, you know, keeping your checks and balance kind of thing, where making sure everything is accounted for, keep your receipts, stay on top of it, understand your money, understand where it's coming from, and understand where it needs to go at the end of the day. I think that's, you know, and that's why we do what we're doing right now too with our financial literacy, kind of our Instagram lives, making sure that the general community has experts speaking on these kinds of questions that they do have. They just maybe not know who to ask kind of thing. So to that point, actually, everybody on the call, we welcome your questions. If you've got any questions for Justine or for Sam, please put them in the chat box on the below screen. You'll see it on the bottom left-hand side, or on the bottom right side, there's a little Q&A feature. Feel free to click on that and ask your questions. While we wait for any of those to come in, do you ladies have any other tips and tricks or any notes that you want to kind of mention in advance of our favorite month of the year, April?
I don't even think it's our favorite month of the year. I feel like it's accountant's favorite month of the year. Like if you ever wonder where your accountant is in May, like, you know, he or she is just living under a rock for the next couple of days.
Yeah, I think my only thing is don't leave it till the last minute. The worst thing you can do is be scrounging in March and April to get your receipts together, to do all of the accounting that you've waited this whole year to do. that will make it seem a lot more overwhelming than if you just keep fairly diligent records the whole way along. If your business is fairly simple, an Excel spreadsheet might be all you need, or there's a lot of apps out there. Tip on that is if you have to pay for it, it's probably better.
Gotcha.
Tax
Any
deductible.
Yeah.
suggestion on the app at all? On any apps that folks can use?
QuickBooks is a really popular one.
Yeah, QuickBooks has a few variations of itself. Like there's a simpler one and a more complex one. There are also apps out there that, if you're doing a lot of driving for business, automatically track your mileage without you having to do anything. You just get in your car with your phone and it tracks everything for you.
Cool. That's tech savvy stuff. I know Lucas has put a question in the chat box here, and it says people often wait until the last minute to start saving up to contribute to RSP season, for instance, and that's very true. What tips do you have for getting ahead of the curve?
I used to be that person.
Yeah, yeah, I still am that person. So I think for me, like, RSP contributions can be daunting if you're making large ones. I think what would help with that is if you're making a small contribution every single month, it's going to be less of an impact if you wait till the final day and you're like, oh, I forgot to put that last $2,000 in. At least you made some sort of contribution in that year. Is a really good tip, is have some sort of recurring contribution that's less impactful to your monthly budget, with still the plan to make another ad hoc contribution, last minute, but hopefully you've, at least kept up that deadline.
That's 100% what I was going to say. I are we frozen? No. We, sorry, I had a moment. We looked frozen.
Yeah, it's back. You're good to go.
Good. Awesome. So so I used to be that person until I went on a monthly contribution. And then it was just like, I knew that this was going to be, especially if you're incorporated and you know what kind of income you're going to be pulling from the corporation. So if you're pulling that salary, and we know you're pulling this salary, and it's going to incorporate some RSP contribution into it, you might as well pay that RSP contribution monthly, because then you don't have to be like, hey, did I put that 20 grand aside for that? Usually if it's in your bank account, you didn't hold on to it to make the RSP contribution, you found something to spend it on. So that's that part of that pay yourself first thing, is put that money aside monthly, and then that at year end, if you want to top it up, you can.
And that's a really good way to kind of go about it, especially I know like some employers or some people that have their own business, they kind of deduct it on a monthly basis anyways. It goes there. So out of sight, out of mind kind of thing. It's already doing it for you. So you don't have to sit there at the end of the day like, oh my God, I have to rack up X amount of dollars to put it into this account, because you already kind of been doing it. So it's a lot better. Yeah, definitely. That's a really great way to kind of go about that. Luke, I hope that answers the question there. But ladies, I love your energy always. And you've been so instrumental in this kind of conversation and kind of getting us geared up for, tax season, and more so kind of helping individuals that have started their own business or do have their own business to kind of understand the ins and outs of, where they can pay themselves, where they can save, where their money can go, and what kind of tax implications they can kind of consider or kind of avoid, or all of it kind of thing. I'm all over the place, but there's a lot to kind of talk about for sure on this fine Tuesday. I don't know what the weather is like in London, but it's bright and sunny out here, which is really makes me happy. No, he's shaking your head. No,
it's sunny. It's just
it's sunny. Oh my God.
Yeah.
I mean, it looks beautiful from inside.
Yes.
The fresh snow that fell yesterday.
Yeah.
Oh yeah, we had snow as well, actually.
We had
Yes.
a lot of it. Yeah.
Well, ladies, thank you so much, folks. In case you tuned in last minute or were not able to kind of watch the entire thing, we've got the recording on our IGTV, and this will be on our Financial Advice for All website as well. Justine, Sam, thank you so much. Stay well and healthy, and hopefully we'll get to see you on here again sometime soon.
Thank you so much. It's always a pleasure being here.
Absolutely. You ladies take care, and
Bye.
we'll see you again soon, folks. Cheers.
Okay, thanks.
Hello, everyone. I believe we are live. Happy